For 15 years, the world has lived inside an illusion. The illusion that money could be free, that debt could grow forever, and that risk could be managed with a press release. After 2008, central banks saved a broken system with a new invention: quantitative easing. They created trillions digitally, buying government and corporate debt to flood markets with liquidity. Borrowing became cheap. Panic disappeared. It worked, for a while. But what began as rescue became addiction. For a decade, interest rates hovered near zero. Governments borrowed freely. Corporations refinanced endlessly. Investors learned the same lesson again and again. When prices fall, the central bank will catch you. Cheap money changed everything. Stocks doubled, homes tripled, crypto minted instant millionaires. Yet the wealth was paper-thin. Productivity slowed. Real wages stalled. The new prosperity came not from creation, but from asset inflation. Money chasing money. Markets stopped reflecting reality. They became reality. And the higher they rose, the more people believed they could never fall. Central banks turned into the gods of modern finance, their balance sheets the scripture of stability. But gods of policy only exist while belief survives. Every empire has its illusion of safety. Rome had silver, Britain had empire. We have central banks. But nothing grows forever. When the cost of money returns, the illusion begins to crack. What follows is not a normal correction. It's the unwinding of the largest synchronized asset bubble in history, a bubble that touches everything: stocks, bonds, real estate, crypto, all inflated by the same force: cheap money and blind faith. This is the story of how 15 years of monetary rescue built the everything bubble, and why, when belief finally breaks, it won't just change markets, it will redefine what money means. The everything bubble didn't begin with greed. It began with fear. In 2008, the global financial system stood at the edge of collapse. Banks failed. Credit froze. Within days, trade, payrolls, and even food supply chains were at risk. To save the system, central banks did something that had never been done at this scale. They created money, not printed, but typed. With a few keystrokes, trillions appeared. The new policy had a technical name: quantitative easing. Its purpose was simple: inject liquidity, restore confidence, restart lending. It worked. Markets stabilized. Banks reopened. Panic turned to relief. But the cure carried side effects no one yet understood. When you make money cheap, everything built on money expands. By 2010, the emergency had become routine. Interest rates remained near zero. ZIRP, the zero interest rate policy. Governments discovered that debt no longer hurt. Corporations realized that refinancing was easier than innovating, and investors learned that every risk could be hedged, not by discipline but by central banks. The world entered the age of financial abundance, an era where liquidity replaced productivity. Trillions of dollars, euros, and yen flowed through the arteries of global markets. Bonds rallied, equities soared. The cost of capital, the very price of time, collapsed. Savers were punished. Borrowers were rewarded. The line between prudence and speculation blurred until it vanished. By 2013, the pattern was clear. Every hint of slowdown brought new stimulus. Every market tremor triggered a central bank response. The phrase, "whatever it takes," became the unofficial motto of modern monetary policy. Yet beneath the confidence, the foundation was shifting. When money is free, risk loses meaning. And when risk loses meaning, prices stop telling the truth. Capital no longer flowed to the most productive ideas. It flowed to the easiest returns. Companies borrowed to buy back their own shares. Venture funds valued startups not by profit, but by promise. Governments financed deficits with bonds that yielded nothing. It was prosperity without productivity. Growth built on credit, not creation. Economists called it the liquidity trap. Interest rates were too low to fall further, yet the economy was too fragile to rise without them. The system had become dependent on stimulus, like a patient who cannot breathe without oxygen. By the mid-2010s, the world was addicted to cheap money. Markets no longer feared recession. They feared withdrawal. The new question was no longer how much growth could we achieve, but how long could the illusion last? And through it all, central bankers became the most powerful people on earth. Unelected, cautious, worshipped. Their words moved trillions. Their confidence moved nations. The Federal Reserve's balance sheet swelled from under $1 trillion to over $4 trillion. The European Central Bank followed. The Bank of Japan went even further, buying equities outright. The modern world had built an economy not on labor or resources, but on liquidity and belief. At the surface, everything seemed stable. Unemployment fell. Markets reached record highs. Politicians claimed victory over crisis. But real wages stagnated. Productivity plateaued. And wealth condensed into the balance sheets of those closest to the source of liquidity, the financial sector. The gap widened between those who owned assets and those who did not. The rich borrowed to buy more. The middle borrowed to survive. The poor watched prices rise faster than pay. This was not prosperity. It was asset inflation disguised as growth. By 2018, the world had forgotten what normal looked like. A decade of cheap money had trained investors, businesses and governments to expect rescue as a right. Markets were no longer measuring the economy. They were being measured by central banks. Every signal of weakness became a reason for stimulus. Every bubble was proof that the system was working. But stability built on intervention isn't stability. It's suspension. And suspension cannot last forever. Beneath the calm markets and rising charts, debt was compounding faster than growth and leverage faster than logic. The question was no longer if the bubble would form. It already had. The only question left was how large it would grow before the illusion began to break. The everything bubble didn't begin with greed. It began with fear. In 2008, the global financial system stood at the edge of collapse. Banks failed. Credit froze. Within days, trade, payrolls, and even food supply chains were at risk. To save the system, central banks did something never attempted at this scale. They created money, not printed but typed. With a few keystrokes, trillions appeared. The new policy had a technical name: quantitative easing. Its goal was simple: inject liquidity, restore confidence, restart lending. It worked. Markets stabilized. Banks reopened. Panic turned to relief. But the cure carried side effects no one yet understood. When you make money cheap, everything built on money expands. By 2010, the emergency had become routine. Interest rates stayed near zero. ZIRP, the zero interest rate policy. Governments discovered that debt no longer hurt. Corporations realized refinancing was easier than innovating. Investors learned that every risk could be hedged, not by discipline, but by central banks. The world entered an age of financial abundance, an era where liquidity replaced productivity. Trillions of dollars, euros, and yen flowed through global markets. Bonds rallied. Equities soared. The cost of capital, the very price of time, collapsed. Savers were punished. Borrowers rewarded. The line between prudence and speculation blurred until it vanished. By 2013, the pattern was clear. Every slowdown brought new stimulus. Every market tremor triggered a central bank response. Whatever it takes became the motto of modern monetary policy. Yet beneath the confidence, the foundation was shifting. When money is free, risk loses meaning. And when risk loses meaning, prices stop telling the truth. Capital no longer flowed to the most productive ideas. It flowed to the easiest returns. Companies borrowed to buy back their own shares. Venture funds valued startups by promise, not profit. Governments financed deficits with bonds that yielded nothing. It was prosperity without productivity, growth built on credit, not creation. Economists called it the liquidity trap. Rates were too low to fall further, yet the economy too fragile to rise without them. The system had become dependent on stimulus, like a patient who cannot breathe without oxygen. By the mid-2010s, the world was addicted to cheap money. Markets no longer feared recession, they feared withdrawal. The new question was no longer how much growth could we achieve, but how long could the illusion last? And through it all, central bankers became the most powerful people on earth, unelected, cautious, worshipped. Their words moved trillions, their confidence moved nations. The Federal Reserve's balance sheet swelled from under $1 trillion to over $4 trillion. The European Central Bank followed. The Bank of Japan went further, buying equities outright. The modern world had built an economy not on labor or resources, but on liquidity and belief. At the surface, everything seemed stable. Unemployment fell, markets hit record highs, politicians claimed victory over crisis, but real wages stagnated, productivity plateaued, and wealth condensed into the balance sheets of those closest to the source of liquidity, the financial sector. The gap widened between those who owned assets and those who did not. The rich borrowed to buy more, the middle borrowed to survive, the poor watched prices rise faster than pay. This was not prosperity, it was asset inflation disguised as growth. By 2018, the world had forgotten what normal looked like. A decade of cheap money had trained investors, businesses, and governments to expect rescue as a right. Markets were no longer measuring the economy, they were being measured by central banks. Every sign of weakness became a reason for stimulus. Every bubble was proof that the system was working. But stability built on intervention isn't stability, it's suspension. And suspension cannot last forever. Beneath the calm markets and rising charts, debt was compounding faster than growth and leverage faster than logic. The question was no longer if the bubble would form, it already had. The only question left was how large it would grow before the illusion began to break. But what looked like growth wasn't growth at all. It was inflation in disguise. The charts were rising, but not for the reasons we believed. The boom of the 2010s wasn't powered by innovation or productivity. It was powered by liquidity, the flow of cheap money that made every investment look brilliant. Central banks had engineered the greatest asset inflation in history. Stocks, bonds, and property rose together, something that almost never happens in a healthy economy. It was a simple formula. When money costs nothing, everything looks valuable. But the consequence is subtle. It reshapes how society defines success. Growth stopped being about output. It became about valuation. Companies no longer needed to make profits. They only needed to grow market share. Investors no longer asked what something was worth. They asked how fast it was rising. The economy had quietly turned into a belief system, one built on rising prices and permanent optimism. By the late 2010s, the idea of cycles itself had disappeared. Recessions, once a natural part of renewal, were treated as errors to be prevented. Central banks became the guardians of eternal expansion, and like every system that tries to eliminate failure, it began to breed fragility. Easy money changes behavior. It changes how risk feels. When capital is abundant, caution fades. When markets always recover, loss becomes unthinkable. It was no longer greed that drove speculation. It was confidence. Confidence that the safety net would never be removed. Margin debt soared. Retail investors flooded trading apps. Venture capitalists funded companies designed to lose money forever. The market stopped asking what is sustainable and started asking, how high can it go? In every bubble, there comes a point when logic gives way to narrative. In the dot-com era, it was the internet changes everything. In the housing boom, it was real estate never falls. In the age of cheap money, it was the Fed will always step in. This belief became self-fulfilling. The more the market trusted the Fed, the higher prices climbed. The higher prices climbed, the more the Fed was forced to protect them. A loop of confidence, a feedback cycle where perception created policy and policy created perception. By 2019, global debt had reached $250 trillion, over 3 times world GDP. Yet markets felt indestructible. Every weakness was seen as opportunity, every correction a buying moment. Don't fight the Fed became the mantra of an entire generation of investors. But all illusions eventually face reality. And reality doesn't arrive all at once. It creeps in slowly, disguised as data. Productivity growth fell below 1%. Real wage growth stalled for a decade. Asset prices detached from income climbed into the stratosphere. When the median home price exceeds the lifetime earnings of a young family, you don't have prosperity, you have distortion. But the distortion was invisible, hidden behind the glow of the stock market. Every portfolio looked strong. Every quarterly report looked better than the last. It was optimism on borrowed time. Economists warned of asset bubbles, in tech, in housing, in credit markets. But warnings were drowned out by momentum. Because in markets fueled by liquidity, momentum is everything. People weren't investing in value, they were investing in belief. And belief, when it becomes collective, feels like truth. The illusion of growth became the growth itself. GDP was supported by wealth effects, consumption was supported by debt. The economy no longer expanded through production, but through perception. It was a system perfectly engineered for fragility, efficient in good times, catastrophic in reverse. When everyone believes prices can only go up, they stop preparing for the day they fall. And when that day comes, it's not markets that break first, and it's confidence. But confidence is a strange thing. It doesn't die from a single event. It fades, quietly, slowly, as doubt seeps through the edges of belief. And in late 2019, the first cracks began to appear. The global economy was slowing. Debt levels were record high. Inflation, dormant for years, began to stir. The illusion of endless growth had reached its natural limit. And then, in the space of months, a new crisis arrived. One that would take the addiction to cheap money to its ultimate extreme. Every era has its gods. Ours wear suits and hold press conferences. They don't rule nations. They rule confidence itself. In the modern age, power isn't measured by armies or empires. It's measured by balance sheets. Central banks became the most trusted institutions on earth, not because they created value, but because they created calm. Their words could move markets faster than war. A single sentence from the Federal Reserve could raise or erase trillions in global wealth. What began as policy evolved into faith. When central bankers said, "We will provide liquidity," markets didn't just react, they believed. Traders no longer watched earnings or fundamentals. They watched interest rates, speeches, and tone. It was no longer capitalism in the classical sense. It was monetary management of emotion. The global economy had turned into a theater of reassurance. Each time fear returned, the solution was the same: print, cut, reassure. It didn't matter if it was Europe's debt crisis, China's slowdown, or Wall Street's correction. The playbook never changed. From 2008 to 2020, the Federal Reserve's balance sheet grew ninefold. The European Central Bank and Bank of Japan followed the same path. In less than 15 years, the world created more new money than in all of prior human history combined. Economists called it quantitative easing. Investors called it stimulus. But in truth, it was faith management. The belief that central banks could engineer endless prosperity without consequence. When markets fell, rates dropped. When markets soared, policy paused. And so long as inflation stayed low, there seemed to be no cost. The machine ran smoothly until the money that fueled it started leaking into the real world. By the late 2010s, asset prices had detached entirely from fundamentals. The S&P 500 rose faster than corporate profits. Property values exceeded median incomes by record multiples. It wasn't wealth creation, it was wealth concentration. Central banks were printing stability for the financial system, but they were quietly exporting instability into society. The top 10% owned most of the assets that benefited from quantitative easing. The bottom half owned none. For every dollar of liquidity added, inequality deepened. Yet few noticed because the illusion still worked. The numbers went up. Confidence stayed high, and faith, once rewarded, doesn't fade. It strengthens. By 2019, the world was fully converted. Investors, governments, and corporations all believed that central banks could control the business cycle itself. Recession was obsolete. Risk was optional. The idea of a free market had quietly vanished. We no longer lived in an economy that responded to fundamentals. We lived in an economy managed by belief. But the problem with faith is that it cannot coexist with reality forever. Sooner or later, policy meets consequence. In early 2020, the first tremor hit. A virus spread across the world. Supply chains froze. Cities shut down. Markets fell faster than at any time in modern history. And in that panic, the religion of money reached its peak. Because when the world stopped, the printing began. In early 2020, fear spread faster than any virus. Borders closed. Supply chains broke. Entire economies went dark. For a brief moment, it looked as if the global system built on confidence would finally face its reckoning. And then, the money printer roared to life. In a matter of weeks, the Federal Reserve created more liquidity than during the entire 2008 crisis. Trillions of dollars, conjured digitally, injected into markets, banks, and governments. Other nations followed: the European Central Bank, the Bank of Japan, the Bank of England. The world's response to shutdown wasn't austerity, it was abundance. For the first time in history, economies printed prosperity out of thin air. People were paid to stay home. Companies received loans they never intended to repay. Markets recovered before hospitals did. Between March 2020 and 2022, global central banks created over $20 trillion of new money. That's more than in all of prior human history combined. It was called stimulus, but it was something else entirely. It was the final acceleration of a system already addicted to liquidity. The world had built an economy on cheap credit. Now, in crisis, it was building one on free money. The results were immediate and surreal. The stock market soared while unemployment spiked. Billionaires gained trillions in net worth as small businesses disappeared. Home prices exploded, even as eviction bans were extended. This wasn't recovery. It was monetary euphoria. Liquidity flooded every corner of the financial system. Every asset, from stocks to crypto to art, inflated together. The more the world shut down, the more asset prices rose. The illusion was complete. In that strange, suspended world, markets stopped reflecting the economy altogether. Wall Street lived in a bubble of liquidity, while Main Street lived in a recession. It was a prosperity without people, a boom in digits, not in lives. Central banks had achieved what seemed impossible, a crisis without consequences. But no miracle comes free. When you create money faster than goods, prices must rise. And by late 2021, inflation, dormant for decades, began to wake. It started quietly. A rise in energy costs, supply chain bottlenecks, shipping containers priced like luxury goods. But soon, it was everywhere. Groceries, rent, fuel. The era of free money was meeting the oldest law in economics. When supply is fixed and demand is infinite, prices explode. Policymakers called it transitory. They said it would pass. But the data told another story. Inflation hit levels not seen in 40 years. And for the first time in a generation, central banks were forced to do the one thing markets no longer believed they could: raise rates. That's when the illusion began to flicker. Because when the cost of money rises, everything built on cheap money starts to fall. Stocks fell, bonds fell, crypto collapsed. The great bull market that had lasted 15 years began to unwind, all at once. The world that had believed in endless liquidity discovered what happens when the tap is turned off. And for the first time in decades, investors faced a truth they had forgotten. Money, like faith, can disappear overnight. Every illusion ends quietly, not with explosions or chaos, but with silence. The world that once celebrated endless expansion was now learning the meaning of contraction. Inflation, once dismissed as temporary, began to erode the foundation of everything built on cheap money. For 15 years, low rates had made debt feel weightless. Now every rate hike brought gravity back. In 2022, the Federal Reserve raised interest rates faster than at any time in modern history. Within months, the cost of borrowing doubled. Bond values fell. Housing markets froze. What had taken a decade to inflate began to deflate in a single year. Technology stocks, the darlings of the previous decade, collapsed. The so-called safe bond portfolios lost a third of their value. Even governments began to feel the strain, as rising yields made debt itself more expensive to maintain. The illusion of infinite liquidity had vanished. For the first time in history, both stocks and bonds fell together. The two pillars of modern investing, risk assets and safe havens, collapsed in unison. It wasn't a crisis of credit, it was a crisis of confidence. The system that once promised stability through intervention was now trapped by its own design. Central banks couldn't print more money without fueling inflation, but they couldn't stop without crashing the markets that depended on them. It was the perfect paradox, created by policy, sustained by belief. Around the world, the symptoms were the same. In the United Kingdom, bond markets revolted, forcing a government to reverse course overnight. In Japan, the yen fell to historic lows as the Bank of Japan defended its yield curve with unlimited printing. And in the United States, the anchor of the global financial system, the cost of servicing the national debt began to exceed the defense budget. Debt had become destiny. Every dollar of new spending required another borrowed dollar just to pay for the last. The debt spiral was no longer theory, it was reality. For ordinary people, the unraveling felt different. Mortgage rates doubled, food prices climbed, savings lost purchasing power month by month. The wealth effect that once fueled consumption reversed. Portfolios shrank, confidence fell. For a generation that had never known real scarcity, it was a shock. The world was rediscovering the true cost of money and realizing that prosperity borrowed from the future must eventually be repaid. The everything bubble wasn't just a market phenomenon. It was a collective mindset, the belief that policy could eliminate consequence. That illusion was now over. The age of easy money had ended, and the age of reality had begun. Markets didn't crash all at once, they decayed, slowly, unevenly, painfully. Each rally was weaker than the last, each recovery shorter, until optimism itself began to fade. This wasn't the end of the financial system, but it was the end of an era, the end of the faith that built the everything bubble. And as the dust settled, one question lingered across boardrooms, trading floors, and living rooms alike. What happens to a world that can no longer afford its own illusion? Every era ends the same way, not with collapse but with recognition, the realization that what we called wealth was leverage, that what we called growth was debt, that what we mistook for stability was suspension. For half a century, America's prosperity has been powered by the global faith in the dollar. It is the world's reserve currency, the language of trade, the backbone of markets. But the same strength that made it supreme also made it fragile. When the entire world depends on one nation's debt to function, that nation becomes both indispensable and trapped. Today, the United States faces a truth every empire eventually meets, the cost of its own dominance. Public debt has passed $34 trillion. Interest payments exceed defense spending. The government can't cut without slowing the economy, and it can't spend without deepening the debt. It is the monetary equivalent of a treadmill, motion without progress. And beneath the numbers lies something deeper, belief. Because the dollar's power isn't STT gold or oil or GDP, it's trust. Trust that America will honor its debts. Trust that its institutions will hold. Trust that its innovation will outpace its mistakes. That trust has survived war, recession, and political division. But like every form of faith, it weakens quietly before it breaks suddenly. Around the world, the same pattern repeats. Nations look for alternatives. Trade begins to diversify. Digital currencies rise in parallel. It isn't collapse, it's transition. The gradual redistribution of confidence from one center of gravity to many. Yet history offers a lesson worth remembering. Empires fall when they deny change. They endure when they adapt. Rome endured for centuries because it reformed its laws before it lost its borders. Britain transformed from empire to economy because it learned to trade what it could no longer rule. America's challenge is different, to turn an economy built on credit into one built on creation again. To invest in real productivity, not just paper valuations. To reward work as much as wealth. To remember that innovation, not intervention, is the true source of resilience. Because the everything bubble was never just about finance. It was about memory, our collective forgetting of what value really means. The correction now underway isn't the end of prosperity. It's a chance to redefine it. Money is not wealth. Liquidity is not strength. Policy is not purpose. When nations remember that, they rebuild. When they forget it, they repeat. The age of cheap money is over. The age of consequence has begun. What comes next will depend on whether we rebuild on the foundation of truth or on the memory of illusion. History doesn't punish, it teaches. The question is whether we are ready to learn. And that is the story of the everything bubble, how cheap money built an illusion, and how when the illusion fades, the world must decide what it truly values. If you found this analysis valuable, And if you'd like to see more stories like this, subscribe and stay informed with the Financial Lens. Every view, every share, every comment helps bring clarity to the noise.